In this video, we'll talk about candlestick patterns. These patterns help traders understand market behavior, but many beginners misunderstand them. Let's simplify everything. Candlestick patterns are formations created by one or more candles. They show buying and selling pressure. Some patterns suggest reversals. Others suggest continuation. Single candle patterns include examples like strong rejection candles. Multi-candle patterns use 2 or 3 candles together. The key idea is market psychology. Patterns show who is gaining control: buyers or sellers. But here is an important warning. Patterns do not work in isolation. Location matters more than the pattern itself. A bullish pattern at resistance may fail. A bearish pattern at support may also fail. Always combine patterns with structure. Use support and resistance for context. Use trend direction for confirmation. Beginners often memorize many patterns, but that is not necessary. Understanding the story behind the candles is more important. Ask simple questions. Was there strong rejection? Was momentum increasing? Did the pattern form at an important level? These questions improve accuracy. Candlestick patterns are tools, not magic signals. Focus on logic, not memorization. Keep your approach simple and consistent. Overcomplicating patterns leads to confusion. Quick recap. Candlestick patterns show buying and selling pressure. They must be used with context. Location matters more than the shape. Keep it simple and focus on structure. In the next video, we'll explain about doji candles.